Hey everyone. Today's questions are, is inflation getting worse or better? Is this a sucker's rally that we're just kind of buying into for the moment? Hang on. This is not financial nor professional advice. This video is for entertainment only. Hey everyone. The big dates for gauging inflation that are coming up are December 1st, when the PCE, which is the personal consumption expenditures, comes out. This is the Federal Reserve's favorite gauge of inflation. But the really big days in December are going to be the CPI, the Consumer Price Index, how much that goes up, and that'll be on December 13th. And right behind that comes the Federal Reserve's decision on how much to raise interest rates, which will be on December 14th. So we got some big days coming up here. We've had a rally of sorts. It's been kind of mixed lately, but I think the market will try to go up, and the Fed is not being hawkish or dovish right now. They're sort of being kind of neutral. One Fed president said that they thought, well, the terminal rate would probably be somewhere between 4.75% to 5.25%. That sounded reasonable to her. I think it was daily. And in any case, the Fed has been signaling that they could soon start slowing the rate of interest rate hikes. So they're indicating, well, we'll probably still raise them, but we might do like 1/4 point at a time. But they're focused on reaching the ideal terminal rate where they want to raise it to, and then hold it for a while until inflation goes down. So we will wait to see what the Fed decides to do on the 14th as far as the rate increase. There's like an 80% chance or more of it increasing 0.5, 0.5%. But one thing I don't like about this market lately is it seems to be creeping up towards 25 on the VIX. And once you get to a VIX of 26 or 27, that indicates we're heavily into a bear market, and it's probably time to start shorting again, or using inverse funds is the way I do it. A positive piece of news on the inflation front was that the PPI, the Producers Price Index, came in lower than expected. Year on year, the PPI, the Price Producers Index, came in at 8.0%, and 8.4 was expected. Month on month, the Price Producers Index, the PPI, came in at 0.2%, and 0.4% was expected. So that was very welcome news. And the core PPI was similarly positive news. The core PPI year on year was 6.7%, and 7.2% was expected. Month on month, it increased 0.2%, 0.2%, when 0.4% was expected. So on both a core PPI level and the headline PPI level, inflation looks to be down. And I think this is the second month in a row that did that. So those increases are passed on to the consumer eventually, but they've been increasing less than expected, which would indicate maybe inflation is being held back in its rate of acceleration. It's still increasing, but at least it's not accelerating wildly out of control, maybe. We're in a phase where some good news turns out to be bad news or can be interpreted differently. And retail sales grew by 1.3%. And so that's viewed that that's an effect of inflation. We're not buying more goods. It's the goods that we do buy are costing more. And so that's probably it's probably causing most of the 1.3 increase. We're not buying more. It's just costing us more to buy it. And so this is one of those, what could look like good news isn't good news because inflation is ruining it. And also Target reported that people have taken to stealing more, and it's organized shoplifting rings where they converge on a store and they just grab things all at once, and a bunch of them run out with goods. And this sort of behavior is really taking a dent in Target's profits. So far in 2022, it's reduced their profit by $400 million, which is very significant. So people are now taking to stealing because of inflation more. We're headed for things that are not good, folks. This is a sad comment on both the behavior of people and the sadness of our economy. And as if we didn't have enough problems with inflation, a Russian missile landed in Poland, on the border of Poland, and killed 2 people. And people start to worry about NATO getting involved with Russia and this leading to World War III, which is our nightmare. But it was found that Russia didn't fire the missile. Basically, Ukraine fired the missile to defend their country from the 100 or so missiles coming in from Russia. So it was a stray accident where Ukraine was trying to defend itself. And so that calmed things down. But on that day, I noticed that it spiked the VIX up to 24.5, which is getting close to the 25 level where I begin to think about shorting. The market has quieted down quite a bit and is trying to decide which direction to go. And in times of uncertainty, it's probably best, and maybe generally best, to play the S&P 500. In the last month, it's been profitable to trade the SPXL, which is a triple leverage bullish fund on the S&P 500. So the S&P 500 generally goes up, except if you're in a terrible bear market, which this year has been. But there's signs that things are coming out of that. We're still going to be under the weather, I think, for a while until it's established that we have a main trend towards inflation getting better. And I think we're beginning to see signs of that. So if I want to triple leverage the SPX, I would do it with XPXL, which is a triple leverage bullish fund on the S&P 500 that so far this month has given you 30% upside. So these leveraged funds, they're triple leveraged, they're intense. But I've been sticking with my ETFs that I do buy because I do believe that the news is it's so negative now, and it's starting to slant towards being positive. And so to me, that's probably the time I want to buy. So when I looking at the chart, when I look at this chart, I see that it's gone up from about $60 to close to $69. You know, these are the kinds of gains you can get with leveraged funds. It's not really a safe strategy. It's something to make quick dollars on. I think it looks like a bounce off the bottom to me. I think we're going to get good news interspersed in with bad news, but we never used to get any good news. So I expected to struggle and kind of hold where it is, but I think there's good reasons to think that it'll go up by the end of the year. And I wanted to show you this chart, which gives you some idea of what it's like to trade in the world of leveraged funds. SPXL is in green. And of course, it's at the top because we've had a rally for the last month, mostly with some mixed up days, I will call it. But it's made 30% in the last month. You know, you can't ask for too much better than that. It's a sign of a bounce off the bottom, or at least an intense bear market rally. And I think it's undecided which it is, but I'm starting to favor the bullish outlook. In red is the SPXS, and that's shorting the SPX. And it is triple leveraged to the downside. It's an inverse fund. For every dollar that goes down, you make a dollar. For every dollar that the index, the SPX, goes down, you make $3. It works the opposite of the way SPXL does. And that has lost 28% in the last month. I always want to provide you with what I think is a sensible middle road. In the last month, SPVU has made 13%, and that's kind of more real, and it's more sensible too, because these are 100 companies of the S&P 500 that the metrics indicate that they are the best values. And it's probably based a lot on price to earnings, that they have a low price to earnings. You are not buying wild stocks with this. You're buying the most valued stocks on the SPX, the Standard & Poor's 500 index. And so that seems like a very sensible way to go. And making 13% in the last month is nothing to sneeze at. And as you can see, it's been a very bumpy ride for the last month, but I've forced myself to hang in there with it. I find to hang on to stocks, you have to have an underlying belief, and my underlying belief is that we're starting to come out of this, and we're going to have rocky times because they will increase the interest rate, but I think they're probably going to do 0.5 in December, and then they will decrease, probably do it 0.25%, maybe 0.5%, but no more than that at a time, and maybe we'll put some 0.25% until they get around 5.5% or so. One of the huge wins for the recent, I got to give you my shirt here as I say this, has been Super Microcomputer, okay? And its symbol is SMCI, and they make all manner of computer equipment and servers. And it's been shockingly good. It's got a good price to earnings, and the price action is just amazing. And this is one where you let the horses run, you let your winners run, and this is a good example of that. And looking at the chart, you can see it has that nice upward movement in the last month that you like to see in a stock, and it is undervalued. Its price is around 87. Its value is about $101. So there's more to come with this stock. Its price to earnings is only a little bit over 9. but its earnings growth rate is what's shockingly good. It's actually equal to Tesla's now, which is I think it's almost equal to Tesla's earnings growth rate, and that's 41%. Tesla might be a little bit more, but not much more than that. This is a solid stock, and I'm going to let this winner run. Of course, not all my trades are winners. The hardest part of trading is dealing with your losers. But what I've learned is you've got to let your winners run, but you got to cut your losers loose too, especially if you're an active trader as I am. So Sigma Lithium Corporation, I wanted to hang on to it. Its symbol is SGML. I wanted to hang on to it. I think electric cars are going to become much more significant in future years, and we will need lithium. And that was my whole premise for buying this. Plus, it had good metrics. But the rumors and the price action and the way other stocks are acting, I think there's better places to invest your money. And looking at the chart, I decided to get out of it when it started to take the dive. And, I have a certain percentage in my mind, usually around 8% loss. I begin to think about getting out, at least temporarily, if I truly believe in the stock. And maybe I will return to this. But I think there's two factors affecting this downturn. There's a rumor that China is projecting that they're going to have reduced demand for lithium in 2023, so that they're taking a more long-range look. And if you're into lithium, you don't want to hear that the demand is decreasing. And also, Tesla's price has taken a dive recently, and they're down in the 183s, the 180s, and it's a relative low point for Tesla, and it doesn't speak well for the current demand. I expect that to pick up, and maybe I will go back to SGML at some point, but I'm going to have to hear good news coming out of China to some degree, and I'm going to have to hear better news about Tesla for sure. I have two triple leveraged bullish funds. One is on healthcare. That's Cure. That's C-U-R-E, like you cure a disease. And then there's DFEN. That's D-F-E-N. And that's on the aerospace and defense industry. It has Boeing in there, which they consider part of aerospace. And then the rest is defense industry that makes things like javelins and stingers and weapons that are used in war. And we have a war going on in Ukraine, and countries are protecting themselves against aggression from other countries. And so we need to provide protection for people that want to live in freedom. And healthcare is always a viable industry. Looking at the chart, the blue line is DFEN, and that includes aerospace and arms weapons that are used in war. And that has done well. That's made about 58%. And healthcare, which I think is actually the safer thing because we will always need healthcare, whereas DFEN depends on the whims of the world to a larger extent. But healthcare, I think, is a long-term hold, whereas DFEN, it's probably a longer-term swing trade in my mind. But the healthcare triple leverage fund Cure is at the bottom, and that's the green line, and they've done 21% in a month, which, this is rock and roll, isn't it? 21% in healthcare, and it's down below DFEN, which is 58% in a month. But this is why I like the leverage funds. You can get these large pops. A stock that's really done well for me is Canadian Solar. Canadian Solar's symbol is CSIQ, and they benefit from the strong dollar. That people in the United States can buy the panels from there cheaper because our dollar is strong, and we get a good exchange rate against the Canadian dollar. And so this has been rewarding financially, and I just like the idea of solar energy. I have 16 solar panels on my house, and it's saved me all kinds of money. So I'm happy to invest in this. Its forward price to earnings is only 9, and its earnings growth rate is outstanding at 30%. So it's considered to be an undervalued company, an undervalued stock. Its current price hangs around 36 or 37, and its value is considered to be above $49. So this is an outstanding value, an outstanding growth stock. I think this is one for the long term. And I'm showing you the 1 month chart to show you that it is making recovery from around 30 and is close to 37 in 1 month. So I think this is the sort of poppage, as I call it, that I like to see in a recovering stock, and especially in a stock that I love. I may be somewhat biased towards the stock because I love the industry, but I think it's a good value. Please smash the like button if any of this has been helpful to you, and send me comments on what you would like to see more of or less of. And I'm very responsive to readers' comments, to watchers' comments. So my channel on YouTube is always welcoming new people and new subscribers. And be sure to subscribe if you haven't done that already. Thanks for watching and listening. Good luck to us all. We're going to need it, but I think we're climbing out of a hole now.